The tale of Jeffery Benson, the currency trader in the bustling city of Financia, where skyscrapers gleamed with neon tickers of currency rates, lived a young and curious trader named Jeffery Benson. Jeffery Benson had recently joined a Forex trading firm and was eager to understand the mysteries of the bid and ask prices that flickered endlessly on his trading screen. One morning, Jeffery approached his mentor, Mr. George Soros, an old but sharp trader who had weathered decades of market storms. "Mr. George," Jeffery asked, "I see two prices for every currency pair. Why is that? Why not just one, Mr.?" George chuckled, sipping his coffee. "The bid price is what the buyer is willing to pay. The ask price is what the seller wants to receive. Say you want to sell euros. You approach a buyer who says, 'I'll give you $1.1000 per euro.' That's the bid. But when you want to buy euros, the seller says, 'You can have them for $1.1002. That's the ask. See the difference? That tiny gap, called the spread, is how brokers and market makers make their money." A trade in action inspired, Jeffery opened a trade. He saw bid 1.1000, ask 1.1002. He clicked buy on USD. "Hold on," he muttered. "Why did my trade open at 1.1002, not 1.1000, Mr.?" George smiled, because when you buy, you're accepting the seller's price, the ask. If you were selling, you'd accept the buyer's price, the bid. That's how it works. Understanding the spread as Jeffery watched the price move, he noticed he was instantly down by 2 pips. "That's the cost of doing business," Mr. George said. "The spread is like a toll you pay to enter the trade." Over time, Jeffery mastered the game, placing trades, watching spreads, and reading the pulse of the Forex market. He learned that a tight spread, small gap, meant high liquidity and lower cost. A wide spread usually happened during volatile news or in exotic currency pairs.